Silver, this is just tough on silver. And the reason I say that is just the same. First of all, the top I had on silver, it wasn't 1979, 1980. It had nothing to do with that. It was simply this. Your COVID low, your low from 2020, which was, this is your COVID low, your 2008 low, so your financial crisis low, to your high in 2011, and a parallel gave us that top.
RBC's October 2025 top things across gold equities frames a market pausing mid-rally. Gold's 66% year-to-date surge, its strongest since 1979 now. It faces correction, risking near 4,100, which we might be near now.
Silver's recent performance remains challenging, reflecting deep structural and historical factors rather than speculative excess. Unlike the rallies of 1979 or 1980, today's movements stem from long-term technical patterns shaped by major global events. The COVID-19 low of 2020, aligned with the 2008 financial crisis bottom, built a strong base that extended into the 2011 highs. When projected forward, these levels created a parallel resistance that defines the current top in silver. This technical ceiling illustrates how historical price memory and global financial behavior continue to influence the market, making silver's current stagnation a product of monetary tension and investor caution rather than weakness in fundamentals. According to RBC's October 2025 report, gold equities are currently in a mid-rally pause. Gold's 66% year-to-date surge, its strongest since 1979, reflects intense safe haven demand, but also signals a possible short-term correction near $4,100 per ounce. Silver, however, finds it difficult to keep pace. The elevated gold-to-silver ratio highlights how gold's monetary appeal overshadows silver's industrial role. While investors continue to favor gold in uncertain times, silver's hybrid nature, part monetary metal, part industrial asset, leaves it more vulnerable to global manufacturing slowdowns and shifting sentiment. Still, silver's long-term outlook remains promising. The accelerating demand for renewable energy, electric vehicles, and advanced electronics ensures that industrial consumption will continue to rise. These structural drivers may eventually tighten supply and lift prices once speculative pressures ease. Historically, periods of consolidation like this have preceded powerful rallies. Therefore, while the present phase may test investor patience, silver's underlying fundamentals, rooted in technological progress and cyclical recovery, position it as a compelling asset for the next phase of the precious metals bull market. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Silver, this is just tough on silver. And the reason I say that is just the same. First of all, the top I had on silver, it wasn't 1979, 1980. It had nothing to do with that. It was simply this. Your COVID low, your low from 2020, which was, this is your COVID low, your 2008 low, so your financial crisis low, to your high in 2011, and a parallel gave us that top. So now let's go back to the charts and let's take a look here, because this is what I want us to pay attention to. This is the daily chart now, and I have my target levels pinpointed, all right? I've literally drawn them on. This is, again, notice this little zone right here, how you popped above and consolidated and then had your final push up. That means this is going to be support, albeit probably minor support. It would be a level where we could see it bounce. Notice the pattern formation. In technical analysis, a sharp drop followed by sideways chop like this on a slight angle even. That is what we call a bear flag. And bear flags have a tendency, a probability to play out to the downside. And that's exactly what we're seeing here. Sharp drop, inside bar. And by the way, so the kicker here, think about this, right, is that you had a lot of selling and then you had some buying, which is why you're getting these tails, right? Buyers are coming in, but notice how price isn't jumping right back to the highs. That means there's still big money dumping in, which is why you're getting these thin body candles with tails on the bottom. The tails are telling you the buyers are there, but it's being met by sellers on the other side. And that's what's creating the bear flag versus if there were no sellers, this would shoot right back up. And so generally, eventually the buyers kind of get exhausted and price falls. And that's where we get into this next target level around 39.48. If it breaks that, we have 38.45 as a second target. Notice again, there's a little pivot point here. And then third target would be 36.95. Now, what's so cool about those are pivot points. But if we look at this, guys, All right. This is really, really important. Look at how when we take the beginning of this up move here and we do a Fibonacci retrace, look, what's this align with? And this is, by the way, this is the most beautiful thing ever because I was able to pinpoint my technical levels. And then I was like, let me just throw a fib on there, a Fibonacci retrace. And lo and behold, it literally lined up almost perfectly with every level. And that adds credence that those levels can be for traders trading long opportunities on gold. And again, listen, there's no guarantees that we even go down to my max drawdown level. But again, it is interesting to see the alignment, right? And so very clear. And by the way, where are we consolidating? The 236 Fibonacci right there. And then right here, 39.48 is almost identically the 382. The 50% is right at this 38.45. The 618 is literally almost to the dollar, 36.95. And then look, even my max drawdown level at 34.85 is basically at the 786 Fibonacci. Now that is cool, folks. That is so, so cool to see how the market acts and how it just forms. And the thing is too,
silver 47.99 right at the lows when this whole thing turned around, down 87 cents. Copper 504, up a little less than tenth of a penny. WTI again up 51 cents at 62.69. Natural gas unchanged bid. Bitcoin up $1,000 at 111. Ethereum up 96 at 3,900. Palladium 1414. Platinum 1589, down 39, down 33 in that order. Gold, silver, 84. I'm looking for gold, silver to stay below 89 now. Soybeans, unchanged. Corn, unchanged offered, and wheat, unchanged bid. So pretty common in the grain side. Metals. Yesterday, I said this could be the bottom in silver, and you have to know that I got long on that. And there was one level that I needed us to break intraday for me to be really confident. RBC's October 2025 top things across gold equities frames a market pausing mid-rally. Gold 66% year-to-date surge, its strongest since 1979 now. It faces correction, risking near 4,100, which we might be near now. Equities, though profitable, lag metal prices, trading at trough valuations despite record 1195 profit margin. So that's a huge margin, right? Costs have become irrelevant as producers swim in cash, with attention shifting to capital allocation and restrained M&A. Reserve conservation persists. Miners resist raising assumed gold prices despite spot surging. Legacy of the mess-ups in the 80s and 90s. Very smart. Preserving profitability, discipline. That's a really good sign, and we're happy to see that. The bank sees near-term volatility, which means up and down, but mostly down. That's what they mean when they say volatility, as healthy within a structural bull market. Structural bull market, with valuations implying 3,500 gold pricing across equities. Continues in the premium post RBC top 5 things about miners now. And the charts are just fabulous.
Silver's recent price movements have posed a challenge. As Vince Lanci explains, silver was based on a parallel analysis linking the COVID-19 low, 2008 financial crisis low, and the 2011 high. This approach highlighted key technical levels, showing how effective chart analysis can help investors anticipate market behavior. By identifying such patterns, traders can navigate volatility more confidently. Notably, gold and silver have been rising alongside major indices like the S&P 500, Dow Jones, and Nasdaq Composite, an unusual trend that points to broader market dynamics influencing precious metals. Gareth Soloway underscores the importance of technical patterns in predicting price trends. He identifies a bear flag formation on the daily chart. The recent sharp gains in gold and silver signal both risks and opportunities for investors, highlighting the need to remain cautious but strategic. By combining technical analysis with broader market insights, traders can better distinguish short-term fluctuations from long-term trends, allowing for more informed decisions in an increasingly complex financial environment.
On gold, this is the gold chart that allowed me to call the near-term top here. It was a beautiful thing. I noticed how in 1979, we had the same sort of pattern up, sideways consolidation, and then 1, 2, 3, 4, 5, 6, 7, 8, 9 straight up weeks in a row. And then lo and behold, over here, look at this, up, sideways, and literally 1, 2, 3, 4, 5, 6, 7, 8, 9 up weeks in a row, leading into this pullback. Pretty remarkable, actually, if you think about it. Now, a lot of people say, well, why is it the same as 1979? And the answer is it's not really the same. Like, in other words, interest rates are going down. In 1979, 1980, Volcker was raising interest rates aggressively. The U.S. debt to GDP was 32% then. It's 130% now. So there's miles of differences, which is why I don't think this is a multi-decade or even multi-year high on gold like it was into the 80s. All right, listen, until the governments of the world, not just the U.S., but the governments of the world stop printing and running up debt and just printing dollars, until the Federal Reserves of the world just don't bail us always out by buying bonds, which forces money. Basically, it's printing money, right? QE, quantitative easing, lowering interest rates. I mean, these are all things that make fiat currency slowly lose value. I mean, if you look at the value of a dollar, of what it buys, going back to the teens or the 20s, the early 1900s, it's literally 99% diluted. And it's not gonna change, right? It's just gonna continue that way because governments are not changing their habits. And as long as that stays the same, then precious metals should increase in value over time. Now, again, runs like we've seen lately, that's not going to be always normal. I think these are playing catch up because they were forgotten about for a long period of time. But still, over time, they should increase. The idea is you buy significant pullbacks.
Gold equity cycle analysis, GDX drawdowns and recoveries, producer margins, cost structures, deleveraging trends, reserve and resource price for a spot in gold, sector valuation metrics, price to net asset value, EV to EBITDA, price to CF and FCF, free cash flow yields, and much more. Let me throw up a chart to that effect. So here's gold price cycles from 2008 to present. Visually, very easy to get. Up, down, right? He does that. They do that for the whole listing of gold since 1970, which makes sense. They break it down logically. Pre-Great Financial Crisis, post-Great Financial Crisis, and then they break down what the retracements are. And then they go down in categories and say how deep is the average retracement. Good, the type of stuff that you would see on a HeartNet report, but visually very conducive to getting the most out of it. I'm going to make it up, but I'm probably not wrong. China probably bought down here. China or a proxy for China, because between here and here is the range. This is going to be crazy to hear, but it's on my radar now. If nothing material comes out of this conversation, maybe we're in a new range from this purple line here, 39.76, to that yellow line there, 43.56. And I say that because, hey, if we're willing to defend that and not let it go above there, and they're willing to defend it down here, then you're going to have another whippy trading range unintentionally designed to make people puke. It's a puking range. So I don't know. I mean, that's it. I'm not trading this right now. I have that long silver position, that's not working out so well. I'll get out of that today, at least half of it. And I would say if you're looking at gold, look at these 3 days here. Whoever sold it up here, I think has got an echo down here. I think it's the same type of seller. This is institutional selling, and this is other institutional selling. I don't know why they picked that price, but they picked that price. I think people are leaning on it now. And after the event, you could have a wild move in gold. You could also have a wild move within this range.
Gold and silver are positioned for continued significance in the financial markets, influenced by both historical price cycles and ongoing macroeconomic conditions. Past patterns indicate that extended rallies are often followed by short-term consolidations, reflecting profit-taking rather than a true reversal, and current monetary policies, including persistent money printing and high global debt levels, suggest that fiat currencies will continue to lose purchasing power over time. This creates a supportive environment for precious metals as long-term hedges against currency erosion and economic instability. However, market activity may remain range-bound for a period, driven by institutional positioning and defensive trading, resulting in short-term volatility. Industrial demand for silver and safe haven interest in gold could intensify upward pressure once these pauses resolve, potentially leading to significant appreciation over the medium term. Given these factors, how might investors strategically balance exposure to gold and silver to capitalize on their long-term potential while managing short-term market fluctuations? If you found this information valuable, Make sure to hit like and drop a comment below with your thoughts. Don't forget to subscribe and turn on notifications so you never miss the latest updates. Thanks for watching.